All right, welcome back. This is going to be our final episode of Make Money Count for the year. I figured what we should chat a little bit about is the most recent CPI numbers, what the market is telling us is going to happen in 2024. So we're going into this brand new year of 2024. Around this time of year, everyone says, these are my plans for 2024. This is what I want to accomplish. What kind of an economic backdrop are we going to see to accomplish all of our goals for 2024? And maybe those goals are buying real estate. Maybe they are selling real estate. Maybe they are just holding on to real estate and what is going to happen with interest rates. So there's a whole host of information that came out in this consumer price index report, which we got on December the 19th. The most important thing that economists looked at was the overline CPI for November, which was 3.1%. This came in a little bit higher than what was expected. Initially, you could see that the reaction was, oh no, is the Bank of Canada going to hike rates again? Everyone's a little bit gun shy right now. Everyone's a little bit worried about what the Bank of Canada might do because of how high interest rates are, how high our borrowing costs are, how crushed the consumer is. And we saw this number and people said, oh, well, maybe there's an issue here. Maybe the consumer is still spending. But when you strip out of this 3.1 CPI number, the borrowing costs and the shelter costs, you start getting a more real indication of what is happening in the economy. There are a few things that are really worrisome here. If we look at how the bond market and the CDOR market, which we love to look at, have digested this information a few days on, you can see that the trajectory and the expectation for interest rates in 2024 hasn't really changed from this CPI number. Anecdotally, the Royal Bank of Canada came out after this and said, we're really not worried about this 3.1 number. We understand that a lot of this is shelter costs and rental costs. We also understand that inflation is a lagging number, that we do continue to see downward pressure on consumer spending and consumer confidence. And as a result, we will still see rate drops in 2024. To whoever thought that that inflation print for November was going to result in an increase in interest rates, don't worry. Interest rates aren't going up anymore. Interest rates are going down. It's just a question of how far down they're going to go in 2024 and how much of an impact that's going to have on our economy. Ideally, inflation comes out of the market, interest rates come down, consumers come back. But this is going to be against a backdrop of weakening employment and the borrowing costs still being elevated into 2024. So the 5-year Government of Canada bond yield right now is about 3.3% today. And that is down from 4.5%. It's a little higher than the kind of low print that we saw. I think it was down to like pretty close to 3% before that November CPI number came out. But still at 3.3%, that means, and we talk about this a lot, 5-year Government of Canada bond yield is the pricing mechanism for the 5-year fixed rate. 5-year fixed rates should always be 1.5% above the 5-year Government of Canada bond. So that would translate into about a 4.8% 5-year fixed rate. Now, we're not there because there's still a lot of profit in those rates. There's still a lot of risk premium in those rates that's being taken out by the banks, but we will get there. And if we look at the CDOR market, we can see there is a almost 100% pricing in of a 25 basis point drop in March. I am not 100% sure that we're going to see that 25 basis point drop in March. And the only reason why I say that is I feel as though the Bank of Canada is going to be a little stubborn to drop rates right at the beginning of 2024. And I think this CDOR market chart is kind of showing the same thing. So what would happen? Let's play this out, right? Like what would happen if the Bank of Canada didn't decrease interest rates at the beginning of the year? It would mean that the economy would continue to slow. It would send a clear message to the economy that the Bank of Canada was going to be really, really tough on inflation. And at this point, being really, really tough on inflation is just being really, really tough on the Canadian consumer and on the Canadian economy. And that would increase the certainty that we would be in a recession. There's a few things that we could look at to indicate that we might be in a recession already. There was a great article in the Financial Post where they quoted David Rosenberg, a notoriously bearish economist, but one that clearly knows his stuff. who says that if you strip out the stimulus in our economy that's relating to immigration, Canada is already in a recession. Canada already has negative GDP. So if we take out the massive number of people that we're pumping into our country, Canada's economy is seriously contracting. That is not the backdrop of an inflationary environment. So if we look at that CDOR chart and we can surmise that the Bank of Canada is going to be tough on inflation, this lagging indicator, which means tough on the consumer, tough on the economy, then it is more likely that we're going to see more significant drops further out as the Bank of Canada, again, overcorrects to be over accommodative to the economy. And that's why we're seeing now it's like a June 2024. It looks like it's a close to 70% chance of that drop. As you go further and further out, we're seeing, December of 2025, a well over 2 percentage points lower on the overnight rate for the Bank of Canada, which means 2 percentage points lower on the prime rate. So what we want is we want to see a more stable chart here, right? Like we don't want to see these massively high probabilities of really, really huge rate drops. You want to see a more even backdrop here for our economy to say that we are going to navigate a soft landing. And from everything that we can understand, inflation's really driving the growth in our country right now. Interest rates are and have really slowed down our consumer and our economy. So for 2024, we can definitely expect lower interest rates. We should be realistic in expecting that the Bank of Canada is going to do what they say, and they're going to be tough on inflation. They're going to be tough on the Canadian consumer, and they're not going to drop rates until very likely the middle of 2024, at which point rates are going to come down. By the end of 2024, 67% chance that we're 150 basis points lower. I want to optimistically bet against that. I want to optimistically say that 1 percentage point will do it in 2024, just because if we drop 150 basis points, it might mean that we've created a real problem in our economy, but I'm not sure. The United States, from all indications from their stock market right now, are going to navigate a soft landing. Again, they may be getting ahead of themselves also. But in Canada, the hope is at least 1 percentage point lower in 2024 for all of us to reduce borrowing costs. And hopefully the economy can kind of remain resilient through that period of time. So if you are looking for a mortgage, I think variable rate, again, we've been saying that a lot lately, is the way to go to take advantage of some of these rate drops. I think that the market for the fixed rate products are still overpriced. And you can see that, like when we look at that bond yield, you can see that the 5-year fixed products that are out in the market are too high. And I think you'd be kicking yourself. You take a 5-year fixed right now, and at the end of 2024, if rates are 1.5 points lower, which they may not be, but they're definitely going to be 1 point lower, you'd be disappointed for having selected that 5-year fixed rate product. And then if you go longer out on this chart, March of 2025, we're at 175 basis points lower. Again, it's a fool's errand to predict interest rates that far into the future, but clearly the bond yields and the CDOR market are telling us rates are as high as they're going to be right now, and they are coming down. And that optimism is what will fuel resilience in the spring market. And I think that's probably something that the Bank of Canada is afraid of, right? Like they don't want to see a spring real estate market happen against a backdrop of the first 50 basis points, 75 basis point that sends property values soaring again. I can't remember a time when I've heard more politicians and economists talking about housing prices. It is scary. Yesterday, Trudeau announced $500 million for the city of Toronto to build more housing. There's a lot of people that are very focused on housing. Everybody has to realize that the reason why we're not building any more houses right now is because interest rates are too high. And the issues with the city of Toronto, namely, or any municipality around Canada, have always been there. And hopefully we can make things easier for developers to develop real estate and as a result, create more housing for Canadians, but that's not going to happen immediately. And the most immediate effect on why we aren't building is interest rates. We could see a June, July, maybe more likely a fall real estate market that shows a lot of resilience against the backdrop of lower interest rates. And then I think at that point, we may be able to kind of tone down some of the verbiage and the rhetoric around housing. but it all starts with interest rates. 2024 will bring us lower interest rates. I don't know if we've seen the last of the kind of price drops in the Canadian housing market. I think until the point that we actually start getting that confidence that rates are coming down, that consumer is going to still be hiding and not spending. From all of us here at Cannect, I wish you a very, very happy holiday and all the best for 2024. And we will see you then.